Hello students, hope you all are doing good. So let's take up with question number 18 of amalgamation now. There is a minor correction also in the balance sheet. So listen the question carefully and make that correction when I discuss it. Okay. DK and JK Limited carrying on similar business, agreed to amalgamate by transferring their business to a new company, DJ Limited. Now, new company DJ Limited is the transferee company, and old companies DK Limited and JK Limited would go into liquidation, so they are transferor companies. Their financial position on the date of transfer 31/3/19 was as follows. Now, equity shares of rupees 100, be careful, face value is 100. So 10 lakhs divided by 100. 10,000 equity shares of DK and 6 lakhs divided by 100, 6,000 equity shares of JK Limited. Same way, preference shares, 6% preference shares are also face value 100. So 10 lakhs divided by 100, 10,000 preference shares of DK Limited and 5 lakhs divided by 100, 5,000 preference shares of JK Limited. 5% debentures only in JK's books 80,000. General reserve, profit and loss account are reserves and surplus. Sundry creditors is an external liability, and statutory reserve, export profit reserve. See, it is mentioned also, statutory reserve. Even if not mentioned, we have seen in past questions that export profit reserve is always a statutory reserve. Land and building, plant and machinery, furniture, debtors, cash at bank and cash in hand. Now here make the correction. Cash in hand amount, it's not 50 to 800, make it 12,800. Make a correction everyone, I repeat. Instead of 52,800, it's a misprinting. Make it 12,800 and you can cross check. If you make it 12,800, the total of JK will come to 15 lakhs. Okay, so make this correction. And what is preliminary expense? It is other non-current asset, or you can say it's a fictitious asset. Okay, it's a fictitious asset means that entry, sixth closing entry comes in the books of transferor company, other non-current assets items. The terms of agreement were as follows. To assume means to take over all assets and liabilities of both the companies, except that provision of 5% be created on debtors. Means what is the agreed value of debtors? 1,63,000 are the debtors of DK Limited. So 1,63,000 minus 5% provision. So 154,850 is the agreed value of debtors of DK Limited. Okay, 154,850 of DK Limited. And same way, 1,04,000. If you subtract 5% provision in that also, then what is the agreed value? 98,800 is the agreed value of JK Limited's debtors. Okay. Next, to discharge, underline the word discharge, the debentures of JK Limited at a premium of 5%. Now this is not a new language for you all. Discharge means its agreed value is 5% more. Premium means its agreed value is 5% more. You can see here, debentures are 80,000, only one company has debentures. 5% premium means its agreed value is 80,000 plus 5%, 4,000, 84,000. By the issue of 7% debentures of DJ Limited, is it mentioned at par, premium or discount? No. That means we issue the debentures at par only. Further, to issue 10 equity shares of rupees 10 each at rupees 12 means premium is 2 rupees, your agreed value is 12. For each preference shares in both the companies, preference shares are also there in this question. For each preference share means for one preference share, 10 equity shares will be issued. Now this is important to be noted. We are settling the preference shares, but we are not giving them preference shares. In the new company, what we are giving them is equity shares. So preference shares of old companies, but in the new company, they are given equity shares. And 10 equity shares, quite obvious, because new company's face value is 10, here the face value is 100. So to match with the old company's face value, you have to issue 10 times shares. That logic can be established. Further, to issue 10 equity shares of rupees 10 each at rupees 12, so same premium is 2 rupees, okay, both the places, and rupees 15 in cash for each equity share in DK Limited. For each equity share, so this was to be paid against the preference shares, and now this is to be paid against the equity shares, okay. And same way, this is DK company, 5 equity shares of 10 each at rupees 12 and rupees 75 in cash for every 2 shares in JK Limited. Okay, this is for DK Limited, this is for JK Limited. Here for each share means for 1 share here, and here for 2 shares means not 1 but for 2 equity shares they'll be given 5 equity shares. And also for 2 shares they'll be given 75 rupees in cash. We'll see in the workings in detail how to do this. DJ Limited to issue 30,000 equity shares of rupees 10 each at a premium of rupees 2.5 per share in the open market for cash so as to meet the working capital requirement. So this is the public issue. So that entry of public issue will also come in the books of transferee company. Now what we are asked is past journal entries in the books of DJ Limited means transferee company and also prepare its opening balance sheet. Two things are asked. No accounting is asked in the books of transferor company. Only transferee company's journal entries and its balance sheet. However, in the beginning, which 3 things we have to decide? First, is it amalgamation in the nature of merger or purchase? Second, method of purchase consideration. Third, if it is merger, we shall be following pooling of interest method, and if it is purchase, we shall be following purchase method of accounting in the books of transferee company. So what are the 3 conditions of merger? First, all the assets and liabilities must be taken over. That is satisfied. Adjustment 1. Assume all the assets and liabilities of both the companies. So all the assets and liabilities are taken over. Second condition, at book value is not satisfied because debtors are taken at different value, 154,850 and 98,800. Even debenture is taken at different value, 84,000. Second condition is not satisfied. Anyone? Third condition is not satisfied. Entire purchase consideration should be settled in the form of equity shares only. But if you see here, adjustment 4, we are paying in cash also. So 2 conditions are not satisfied. It is not amalgamation in the nature of merger. It is amalgamation in the nature of purchase. Now which method of purchase consideration? It is net payment method because adjustment 3 and 4 confirm that. All the modes of payments as well as their details are given. Nothing is missing. Okay, no details of payment are missing. Against preference shares we are giving equity shares. Against equity shares we are giving equity shares and cash. 3 modes of payment. Actually 2 modes of payment. Equity shares and cash. Okay. So net payment method. And because it is purchase method of accounting, we will follow purchase. Because it is amalgamation in the nature of purchase, we will follow purchase method of accounting. I hope everyone is confident with this now. So first working we will make for debentures. Obviously all of you can try it on your own, pause the video and then play and check it whether you got it correct or not. No accounting is asked in the books of transferor company, mind well. First, 5% debentures are 80,000. Okay, 5% debentures of, and they are of which company? JK Limited. 5% debentures of JK Limited, 80,000. Now they are discharged at 5% premium. 5% premium means we have to pay 5% more amount. So 80,000's 5%, we have to pay 4,000 more. What is the agreed value of debentures? 84,000. Okay, 84,000 is the agreed value. Now it is to be discharged by giving 7% debentures, and that too nothing is mentioned, means at par. So what are the number of 7% debentures of new company DJ Limited to be issued at par? Okay, number of 7% debentures of DJ Limited to be issued at par. So 84,000 is the agreed value divided by 100. 840 debentures are to be issued at par in the new company. Now second workings we have to make of purchase consideration by net payment method. Okay, purchase consideration in bracket net payment method. In net payment method we have to consider different modes of payment. First we find it for DK Limited. There are two companies, so we have to find purchase consideration for both the companies separately. First we work it out for DK Limited. Okay. Now adjustment 2. Now adjustment 3. To issue 10 equity shares of 10 each at rupees 12 for each preference shares in both the companies. First, preference shareholders. They are given what all things? Preference shareholders. Mind well, we are paying to preference shareholder, but the mode of payment is equity share only. What we are giving to them is equity share. Now, how much equity shares? See that for each preference share, 10 equity shares are given in the new company. Okay, for each means for one preference share, 10 equity shares are given. Now in the old company, you all can see in DK Limited, there are 10,000 preference shares. Okay, 10 lakhs divided by 100, 10,000 preference shares. So for 10,000 preference shares, how many equity shares will be given? 10,000 into 10 divided by 1. 1 lakh equity shares will be given. Now they are given at 12 rupees. Okay, they are of 10 each, but they are given at 12 rupees, premium of 2. So what will be paying to preference shareholders? We are giving to preference shareholders, but we are giving them equity shares. How many equity shares? 1 lakh equity shares of rupees 10 each at rupees 12. So 12 lakhs is what we are going to pay to preference shareholders, but in the form of equity shares. After preference shareholders, equity shareholders. Okay, what payment are we making to equity shareholders? There are two modes of payment to equity shareholders. Okay, there are two modes of payment to equity shareholders. First is equity shares and second is cash. Now, how many equity shares see here? Adjustment 4. To issue 10 equity shares of 10 each at rupees 12 and rupees 15 in cash for, now this is important, for each equity share in DK Limited. Each means 1. For each equity share means 1 equity share. 10 equity shares are going to be issued. Now there are 10,000 equity shares in DK Limited. So for 10,000 equity shares, again how many shares will be issued? Same 10,000 into 10 divided by 1. 1 lakh equity shares will be issued. And again 12 rupees. You all can see here 1 lakh equity shares will be issued. They are of 10, but they are issued at rupees 12. So 1 lakh equity shares will be issued of rupees 10 each but at rupees 12. So 1 lakh into 12, again the value is 12 lakhs. Okay, to preference shareholders also we are giving equity shares of 12 lakhs. To equity shareholders also we are giving equity shares of 12 lakh. Now equity shares is one mode of payment. The other mode of payment is cash. To equity shareholders we are also paying cash. How much cash we are paying? Here we are giving only equity shares for preference. Rupees 15 in cash. See this, rupees 15 in cash for each equity share. Rupees 15 in cash for each equity share. So there are 10,000 equity shares in DK Limited. Everything one will get 15 rupees in cash. So 10,000 equity shares of old company multiplied by, they will get 15 rupees in cash. 1,50,000 they'll get in cash. So what is the total purchase consideration of DK Limited? 12 lakhs plus 12 lakhs, 24 lakhs plus 1,50,000, 25,50,000 is the purchase consideration of DK Limited. Okay, purchase consideration of DK Limited. Now same way we find it for JK Limited. Two transferor companies are there here. Okay, again first preference shareholders. In JK Limited also we have preference shareholders. Preference shareholders, but the mode of payment is equity shares. What we are giving to preference shareholders, the mode of payment is equity shares. Again, same adjustment 3. It was given to issue 10 equity shares of 10 each at rupees 12 for each preference shares in both the companies. In both the companies means here also the settlement is same. For each means for one preference share, we are going to give 10 equity shares. Now how many preference shares are there in JK Limited? 5,000. Okay, so for 5,000 preference shares, how many equity shares will be issued? 5,000 into 10 divided by 1. 50,000 equity shares will be issued and at rupees 12. So 50,000 equity shares of rupees 10 each at rupees 12. So 50,000 into 12, how much are we going to pay in the form of equity shares to the preference shareholders of JK Limited? 6 lakhs. Now equity shareholders, we are having two modes of payment. So equity shareholders, first mode of payment is equity shares. Okay, first mode of payment is equity shares. Now again coming back to adjustment 4, second part in adjustment 4 refers to JK Limited. From here onwards read it. 5 equity shares of 10 each at rupees 12 and rupees 75 in cash for every 2 equity shares in JK Limited. For every 2 shares, you'll give 5 equity shares. So now the equation would be this way. Second part you read it first. For every 5 equity share of JK Limited, for every 2 equity shares of JK Limited. Okay, second part we will mention first. For every 2 equity shares of JK Limited, 5 equity shares will be issued in DJ Limited. And in JK there are 6,000 equity shares. So for 6,000 equity shares, how many? 6,000 into 5 divided by 2. 15,000 equity shares will be issued. Now 15,000 equity shares of rupees 10 each at rupees 12. So 15,000 into 12, 1,80,000. Okay, 1,80,000 of equity shares will be paying to the equity shareholders. And second mode of payment is cash. But even in cash, it is mentioned, we will give rupees 75 in cash, but for every 2 equity shares. I read that again. Rupees 75 in cash for every 2 equity shares in JK Limited. So again, we'll have to make an equation. For 2 equity shares, you will give rupees 75 in cash. And there are 6,000 equity shares in JK Limited. So for 6,000 equity shares, how much in cash? 6,000 into 75 divided by 2. Okay, 6,000 into 75 divided by 2. That comes to 2,25,000. Yes. 2,25,000 you will pay in cash to equity shareholders. So what is the purchase consideration of JK Limited? 6 lakhs plus 1,80,000 plus 2,25,000, that is 10,05,000 is the purchase consideration of JK Limited. I hope everyone is clear with this, and if you have tried on your own, you all are able to get this. Now, very long workings, first for DK Limited, then for JK Limited. Now, because we are making the workings, let's also make the working of goodwill or capital reserve, because that will be required in the second entry. Now, we are directly asked the entries in the books of transferee company only. So, third working, first we will find net assets. Then we'll compare it with purchase consideration and decide if we are paying more goodwill, if we are paying less capital reserve. So net assets, agreed value of assets taken over. Okay, agreed value of assets taken over. Since we are finding it for goodwill and capital reserve, we can combine it for both the companies. So see the balance sheet. Land and building, no different value is given in the adjustments. So agreed value is 9,30,000 plus 5,10,000. That is 14,40,000. Land and building, okay, 9,30,000 plus 5,10,000, 14,40,000. Then after land and building, what do we have? Plant and machinery, 11,20,000 plus 7,16,000, so 18,36,000. Plant and machinery, $11,20,000 plus 7,16,000, 18,36,000. Then after plant and machinery, which next asset do we have? Furniture, 1,58,000 plus 68,000, that is 2,26,000. Okay, furniture, 1,58,000 plus 68,000, 2,26,000. Then after furniture, what do we have? Debtors. But debtors agreed value is given 154,850 plus 98,800. That is 253,650. Okay, debtors, 158,850 plus 98,800. So 2,53,650. One five 4850. Okay, plus 98,800. So that comes to 253,650. Okay, 154,850. Then cash at bank 1,12,000 plus 89,200. So 2,01,200. Cash at bank means bank balance 1,12,000 plus 89,200. So that comes to 2,01,200. Then cash in hand 1,74,000 plus, as I made you do the correction, 12,800. So 1,86,800. Okay, cash in hand means simply cash. 1,74,000 plus, as I made you do the correction, 12,800. So 1,86,800. Now, preliminary expenses won't be taken up. That is a fictitious asset. They are never accepted. We have seen in the very second lecture in net asset method and net payment method also that fictitious assets won't be taken into consideration. So that will not be included. Okay. Now if we add all of them, okay, 14,40,000, all of you do it in calculator, plus 18,36,000 plus 2,26,000 plus 253,650 plus 2,01,200 plus 186,800. You all must get 41,43,650. From that we will subtract agreed value of liabilities taken over. Okay, agreed value of liabilities taken over. Now there are only two liabilities. One is 5% debentures, and in working note 1 we have obtained its agreed value as 84,000. Only one company has debentures, that is JK Limited, and its agreed value is 84,000. Then sundry creditors 1,50,000 plus 70,000. Okay, sundry creditors 2,20,000. Sundry creditors 1,50,000 plus 70,000. 2,20,000 is its agreed value. In fact, book value itself is the agreed value. So 84 plus 2,20,000, 3,04,000 is what we have to subtract. 41,43,650 minus 3,04,000. So net assets taken over of both the companies jointly are 38,39,650. Okay, assets minus liabilities, these are the net assets. Now we have to compare that with purchase consideration. Okay, that we have to compare with purchase consideration. So now how much is purchase consideration? Okay, total purchase consideration, what we have got? All of you can see that purchase consideration is 25,50,000 for DK Limited plus 10,05,000 for JK Limited. So total purchase consideration what we have obtained for both the companies is 25,50,000 plus 10,05,000. That is 35,55,000. Now for the first time you'll find we are paying less. For the first time you'll find that we are paying less. Or if you can see here, 35 lakh 55,000. Okay, every question up till now we have been paying more. For the first time you find we are paying less. 38 lakh 39,650 minus 35 lakh 55,000. How much we are paying less? 2 lakh 84,650 we are paying less. That is capital reserve. All other questions done in this chapter so far, every time we have got goodwill, but for the first time you find that we are paying less. We are paying less means it's a capital profit for DJ Limited new company, and being a capital profit it is transferred to capital reserve. Okay, so keep this in mind. All other questions we have been paying more. Okay, so 2,84,650 is the amount of capital reserve. Now, all of you make the format. All of you make the format in both the books. Sorry, in the DJ Limited's books. Journal entries and balance sheet are asked, so make a format of journal entries. Pause the video, make the format, and then you can do journal entries along with me. Or alternatively, you can try on your own and then you can play the video and verify you got it correct or not. Yes, so I hope everyone has drawn the formats by now. Okay, I hope everyone has drawn the formats. Let's start with the entries. Now, first entry is for taking over the business, for purchasing the business. So for that, the entry is business comes in, debit what comes in. So all of you write down business purchase account debit. Okay, I hope everyone remembers the entries and keep it in mind. We have to follow purchase method of accounting. Okay, so business comes in, debit what comes in, business purchase account debit. With the purchase consideration what we have obtained total for both the companies, so 25 lakh 50,000 plus 10 lakh 5,000, 35 lakh 55,000. And amount is payable to the liquidator, credit the payable, so to liquidator of DK Limited account with its purchase consideration of 25 lakh 50,000 and to liquidator of JK Limited account with its purchase consideration of 10 lakh 5,000. Okay, you all can see here 25 lakh 50,000 for DK and 10 lakh 5,000 for JK. Being business of DK Limited and JK Limited purchased. Okay, being business of DK Limited and JK Limited purchased. Now, second entry is for taking over assets and liabilities. So, in purchase method of accounting, the entry is assets account debit, not including fictitious assets, excluding fictitious assets or other non-current assets and at agreed values. To liabilities, excluding reserves and at agreed values, and to business purchase. In difference, goodwill or capital reserve, here we have capital reserve, we have already seen in the workings. So directly from this working note we will take up. Assets account debit means land and building account debit with 14 lakh 40,000. Okay, land and building account debit with 14 lakh 40,000. The next asset is plant and machinery account debit with 18 lakh 36,000. Okay, plant and machinery account debit with 18,36,000. The next asset is furniture. Furniture account debit with 2,26,000. Furniture account debit 2,26,000. Then after furniture we have debtors. Debtors account debit with 2,53,650. Okay. Debtors account debit with 2,53,650. Okay, then after debtors we have bank. Bank account debit with 2,01,200. Bank account debit 2,01,200. Then after bank we have cash. Cash account debit with 1,86,800. Cash account debit 1,86,800. Now earlier we always used to debit goodwill also, but we don't have goodwill. Instead of goodwill we have to capital reserve. So capital reserve we will not debit, we will credit. To capital reserve account in bracket working note 3. From third working note we have capital reserve 2,84,650. Okay, 2,84,650. Then two liabilities, in that we have to 5% debentures with the agreed value of 84,000. Then to creditors, sundry creditors or creditors account with 2,20,000. 2,20,000. And then to business purchase. Okay, assets account debit to liabilities account to business purchase account with purchase consideration 35,55,000. Now here I told you people that you match the debit and credit amount. So 14,40,000 plus 18,36,000 plus 2,26,000 plus 253650 plus 201200 plus 186,800. That comes to 41,43,650. Now that amount should match with the credit amount. So 2,84,650 plus 84,000 plus 2,20,000 plus 35,55,000. That also comes to 4,14,000 for 41,43,650. So probably this entry is correct. Okay. Now, next, after that, entry number 3. Okay, being assets and liabilities of DK Limited and JK Limited taken over. Yes, so third entry of settlement of purchase consideration. Liquidator is the receiver, debit the receiver. So liquidator of DK Limited account debit with 25,50,000. Then liquidator of JK Limited account debit with 10,05,000. And How did we pay this purchase consideration? Now see the working note 2, you all will understand it. There are only two modes of payment. One is equity shares, the other is cash. Even to preference shareholders, what we have paid is equity shares only. Okay, even to preference shareholders, you all can see what we are giving is equity shares only. So basically there are only two modes of payment, that is equity shares and cash. Now how many equity shares are given? See here, 1 lakh equity shares to the preference shareholders of DK Limited plus 1 lakh to the equity shareholders of DK Limited plus 50,000 to the preference shareholders of JK Limited plus 15,000 to the equity shareholders of JK Limited. So 1 lakh plus 1 lakh, 2 lakh plus 50,000, 2 lakh 50,000 plus 15,000, 2 lakh 65,000. 2,65,000 equity shares are issued total. So equity share capital account we will credit with the face value to equity share capital account. 2,65,000 equity shares into face value is 10. So 26,50,000. And same 2,65,000 equity shares, 2 rupees of premium will go to security premium account. So to security premium account, same 2,65,000 equity shares into 2 rupees of premium, 5,30,000. Okay, here you all can see 10 rupees shares, but issued at 12 rupees to preference shareholders also and equity shareholders also. So in both the situations you all can see premium is 2. So entire 2,65,000 equity shares, 2 rupees of premium, security premium account, and to cash and bank account we can combine to cash and bank account. Now how much is paid in cash to the equity shareholders of DK Limited? 2,25,000, and sorry, JK Limited is 2,25,000 and DK Limited is 1,50,000. So 1,50,000 plus 2,25,000. How much is paid in cash? 1,50,000 plus 2,25,000, that is 3,75,000. Okay, here also you can cross check. 26,50,000 plus 5,30,000 plus 3,75,000 will match with 35,55,000. Okay, I repeat it. How is this 2,65,000 obtained? Okay, 1 lakh equity shares plus 1 lakh equity shares. These are given to preference shareholders and equity shareholders of DK Limited plus 50,000 equity shares given to preference shareholders of JK Limited plus 15,000 equity shares given to equity shareholders of JK Limited. Okay, all of you can see this once again. 1 lakh plus 1 lakh plus 50,000 plus 15,000. Okay, 1 lakh to preference shareholders of DK, 1 lakh to equity shareholders of DK, 50,000 to preference shareholders of JK, 15,000 to equity shareholders of JK. So total 2,65,000 equity shares. This is how we obtain. Being purchase consideration settled. Okay, being purchase consideration settled. Now, fourth entry, for liquidation expenses, we don't have. See the adjustments. Do we have any liquidation expenses? No. Fifth, okay, fourth entry was issue of shares in public, that we have fifth adjustment. Public issue is there. 30,000 equity shares are issued of 10 each, but at a premium of 12.5, means the value is 10.5 plus 12.5, 2.5, 12.5. Okay, 30,000 shares at 12.5. So two entries will come for that. First, bank account debit to equity share application and allotment account. Okay, bank account debit to equity share application and allotment account 30,000 equity shares are issued and at 12.5 rupees. So 30,000 into 12.5, that is also 3,75,000. Being application money received. Then second entry, we will transfer. So equity share application and allotment account debit with full amount of 3,75,000 to equity share capital account. Now capital account with face value. So 30,000 shares are issued in public. 30,000 into 10 rupees of face value, 3 lakhs will go to share capital account and to security premium account with the amount of premium. So 30,000 into 2.5 of premium will go to security premium. $75,000 being 30,000 shares or application money transferred. Here we'll write being application money transferred. Now, after that, liquidation expenses we don't have, establishment or other expenses, registration expenses we don't have in the adjustments, settlement of liabilities we do have. So this 5% debentures account which we credited, okay, 5% debentures which we credited with 84,000, we will reverse and debit and close that. 5% debentures account debit 84,000. And against that we are giving 7% debentures at par. So to 7% debentures account 84,000 being 7% debentures issued against 5% debentures. And the last entry is for, do you all remember extra entry, last entry for statutory reserve? Here we do have that. Okay, in this question, export profit reserve is there, 1,20,000. For that, we have to pass one extra entry here for taking over the statutory reserve. So, amalgamation adjustment account debit. Okay, amalgamation adjustment account debit with what amount? With the statutory reserve of 1,20,000. To export profit reserve account 1,20,000. Okay, to statutory reserve. So to export profit reserve account 1,20,000 being statutory reserve taken over. Being statutory reserve taken over. Now for the formality we have to do the totals. Okay, so 35 lakh 55,000 plus 14 lakh 40,000 plus 18 lakh 36,000 plus 226,000 plus 253 650 plus 2 lakh 1,200 plus 186 800 plus 35 lakh 55,000 plus 3 lakh 75,000 plus 3 lakh 75,000 plus 84,000 plus 1 lakh 20,000. So that comes to 1 crore 22 lakh 7,650. Okay, 1 crore 22 lakh 7,650 total of journal. Now all of you will be doing is make a blank format of journal, sorry, balance sheet. Okay, blank format of balance sheet, and then we'll make the notes, and then we will do fill in the blanks in the balance sheet. So notes I'll be showing it to you, and then balance sheet will be ready in front of you. You will cross verify whether you got it correct or not. So pause the video and make a blank format of balance sheet, and then we continue with the notes. Yes, so I hope everyone should have done the formats of balance sheet. Now let's first make the notes. Okay, after the notes we will make the balance sheet. So first note is always share capital. Okay, first note is always share capital. Now here we will get the entire balance sheet from the journal entries itself, because a new company is being formed. So if you look at the journal entries for share capital, entry number 3 we have 2,65,000 equity shares. Entry number 4 we have 30,000 equity shares which are issued at 12.5 each. Okay, but finally the equity shares are 2,65,000 plus 30,000, 2,95,000. Total 2,95,000 equity shares are issued by the company. So first we will write authorized capital. Authorized capital is not given in the question, so we will write question mark and double underline. Then issued, subscribed and paid up capital. Now in issued, subscribed and paid up capital, as I discussed with you, 2,95,000 equity shares. Okay, how come 2,95,000? 2,65,000 are issued to DK and JK Limited and 30,000 are issued in the public. So 2,95,000 equity shares of rupees 10 each. That is 29,50,000. Preference shares will not come because preference shareholders are also given what? Equity shares. So now in the new company we don't have any preference shares. Now here we have to write the disclosure of above. See, 30,000 are issued in public for cash. How many are other than cash? 2,65,000 equity shares. Of about 2,65,000 equity shares are issued to DK Limited and JK Limited okay, DK Limited and JK Limited for consideration other than cash. So that disclosure we always have to mention how many shares are issued for consideration other than cash. Total will be 29,50,000. Now second working note is of reserves and surplus. Now what all will come in reserves and surplus? Be attentive everyone. We mark it in blue. Okay, share capital we marked it in green. Now reserves and surplus, we will have this capital reserve of 2,84,650. Very first, capital reserve 2,84,350. Okay. Then after capital reserve 2,84,650, not 350, 650. We have security premium. Okay, next reserves and surplus is security premium. Now how much is security premium? See here, we again mark it in blue. Security premium 5,30,000 plus this entry number 5, 75,000. Okay, 5,30,000 plus 75,000, 6,05,000. So security premium in bracket 5,30,000 plus 75,000, 6,05,000. And then we have export profit reserve, statutory reserve of export profit reserve. Last entry what we had, 1,20,000. Okay, export profit reserve of 1,20,000. So what are the total reserves and surplus? We will have 2,84,650 plus 6,05,000 plus 1,20,000, 10,09,650. Then third note is of long-term borrowings. Okay, non-current liability, very first thing what we have is long-term borrowings. In that we have this 7% debentures which are issued by the new company. Okay, 7% debentures of 84,000. Total also 84,000. Now, after 7% debentures, what we have next is long-term borrowings. Then in the balance sheet, next after long-term borrowings, current liabilities. In current liabilities, we have short-term borrowings. Here we don't have any short-term borrowings. Then we have trade payables. So in that we have creditors here. Creditors from the journal entry we get how much? 2,20,000. Okay, creditors 2,20,000. Bills payable are not there. So trade payables 2,20,000. Then short-term provisions we don't have. Other current liabilities we don't have. Then current assets. In assets, non-current assets, in that very first is tangible fixed assets. Now in tangible fixed assets, we have two things here. One is land and building. Okay, three things: land and building, plant and machinery, and furniture. Land and building 14,40,000. Then plant and machinery is 18,36,000. Okay, plant and machinery 18 lakh 36,000. And then we have furniture. Furniture is 2 lakh 26,000. So 14 lakh 40,000 plus 18 lakh 36,000 plus 2 lakh 26,000, 35 lakh 2,000. Okay, total 35 lakh 2,000. Yes, after other non-current assets, then in current assets, current investments, we don't have inventories, we don't have, okay, there are no inventories also, stock is also not there in the entry. So directly debtors. Debtors will come in trade receivables. So seventh is trade receivables. In that debtors, now how much are debtors? 2,53,650. Okay, debtors are 2,53,650. Bills receivable we don't have in trade receivables, so total also 2,53,650. Then after trade receivables, short term loans and advances we don't have. Cash equivalents, okay, cash and cash equivalents. Now here we will combine cash and bank balance. So I have told you this earlier also. Whatever cash and bank account we debit, we will add, and whatever we credit, we will minus. So I'm marking it in red so that you understand it. Bank account 2,01,200 we will plus. Cash account 1,86,800 we will plus. And again this bank account 3,75,000 we will plus. Okay, three amounts we will add. Which three amounts we will add? 2,01,200 plus 1,86,800 of cash plus 3,75,000 of again cash in bank by received by issue of shares in public. And credit amounts we will minus. So all credit amounts we have this 3,75,000 amount we have credit, that we will minus in third entry. So minus 3,75,000. So that would come to 2,01,200 plus 186,800. That is 3,88,000. Okay, cash and bank balance jointly 3,88,000. That is cash and cash equivalents. Now we have to cross verify and put the things in the balance sheet. So in the balance sheet, all of you should have done the formats. Write down equity and liabilities, shareholders funds, share capital from note 1. All of you can see this amount of 29,50,000. Okay. Then reserves and surplus, all of you can see this from note 2. We got 10,09,650. Total 39,59,650. Then from note 3, this long-term borrowings, we got 84,000. Okay, from note 3, long-term borrowings 84,000. Total of non-current liabilities 84,000. Other non-current liabilities and long-term provisions we don't have. Short-term provisions we don't have. Trade payables, you can see from note 4 we have 2,20,000. Okay, trade payables. Other current liabilities and short-term provisions we don't have, total 2,20,000. Balance sheet total 39,59,650 plus 84,000 plus 2,20,000, 42,63,650. Now in non-current assets, fixed assets, tangible, from note 5 you all can see we get 35,02,000. Then other current, okay, intangible assets we don't have. Non-current investments we don't have. Long-term loans and advances we don't have. Non-current assets, other items, this amalgamation adjustment of 1,20,000, all of you can see that. Total 35,02,000 plus 1,20,000, 36,22,000. Current investments we don't have. Investments we don't have. In fact, inventories, okay, this should be inventories. Inventories also we don't have. Then trade receivables we do have. Okay, trade receivables, all of you can see in note 7. We have it with 2,53,650. Then cash and cash equivalents, all of you can see in note 8, we have 3,88,000. Short-term loans and advances and other current assets we don't have. 253,650 plus 3,88,000. Total current assets 6,41,650. And again 36,22,000 plus 641,650. 42,63,650 is the total of balance sheet. So all of you can pause the video and make this balance sheet and verify whether you got it correct or not. Okay. All of you can pause the video and make this balance sheet from the notes. So that will be all for today's lecture. Bye everyone. Take care. See you in the next lecture.